Are we in a country where stock market is fizzling out and the rupee is completely spiraling in this downward way?
We have a $700 billion currency reserve. Technically, the rupee should have been stable. What happens when rupees come in? RBI increases its reserves, and when dollars go out, RBI is supposed to give out the dollars by selling them in the market.
My expenses are going up by more than 0.7%. But if you average over 10-15 years, it's actually not been so bad for you. I actually don't feel much better about it. What am I missing?
RBI conducts a survey every month, and they do an inflation expectation survey. And usually people say their inflation is higher than it actually has been. That's because people feel that inflation differently. But what RBI tracks is there was a show in the US called Who Wants to Be a Millionaire? And $1 million still is a decent amount of money in the US. India built something called Kaun Banega Crorepati. A crorepati will not buy you half a matchbox in Bombay. It is really that inflation creates a problem with, which is...
It looks like we're going to enter a virtuous cycle where prices will go up, but at a slower pace than they have been historically.
Honestly, we should expect that simply because productivity is taking over.
When it comes to 2026 and beyond, which side of this equation is more likely to dominate? Deepak, the last few months have been a bit of contradictions, if you ask me. When I look at the newspapers, I see one set of very positive data. The RBI is out there saying that GDP growth is 8.2%, which seems astonishingly good. I thought it was nominal, but apparently it turns out to be the real GDP growth is that high. At the same time, inflation, a November print has come in at 0.7%. That's like sub 1%. I think this is the first time in my living memory that India has inflation so under control and the US has runaway inflation that they're struggling to deal with. But when I look at my own, say, personal portfolio or personal experience, I mean, these two numbers are great. But when I look at my stock market returns, since all my money isn't in the Nifty, it's actually quite unfavorable. I would say a lot of the investments are negative year over year or only slightly positive. And when it comes to the rupee, and so my ability to spend, we're at 91 as we're recording this episode, and I'm almost terrified to predict what it will be by the time we push out this episode. So I've been wondering which of these two are correct. Are we in a country where GDP growth is booming, inflation is under control, or are we in a country where the stock market is like fizzling out and the rupee is completely spiraling in this downward way? Could we get into all four of these one after the other and figure out when it comes to 2026 and beyond, which side of this equation is more likely to dominate? So I thought maybe let's start with, well, you can take your pick, but I was thinking maybe let's start with inflation.
I think inflation, whatever the measurement is, the problem is the way that it is perceived is very different from what it is. When they say inflation is going down, the first thing I hear is people say, but my prices are not going down, my prices are going up. Well, yes, but they're going up at a lower pace. And it is a number compared to 1 year ago, where there might have been a spike last year and therefore it looks low. But if you look at it over a longer time period, it's different and so on. So yes, inflation headline number came in at 0.71%, caused a lot of outrage. Every time I post this on Twitter, it's like, oh, Deepak, you're so disconnected from reality. I have no skin in this game in beyond. I am using the same data that Mosby is using to reveal this. And I don't have any special collection mechanism myself. If you ask me my inflation, I have tracked it from 2006. It's about 5%. But that would not be what your inflation is. Your inflation could be 8%. Somebody else's inflation could be lesser. And one of the ways the problem is if you look at inflation over a 5-year period and annualize it.
So the whole country.
The whole country.
Not just personal.
Not just personal, the whole country. Then you get a more meaningful concept of inflation. So right now, it is not 0.71% over 5 years. It is 4.5%. It is the lowest it has been for the last 5 or 6 years, but it is still 4.5% per year.
Over the last 5 years.
5 years, which means in COVID, that if you had gone to a restaurant and ordered a dosa and paid rupees 100 for it, assuming the restaurant was open and serving you and you were wearing
we'll run with it.
And all
Yeah.
that, you can go to the restaurant now and say, I will pay 135 rupees for that dosa because it is 4.5% inflation per year, annualized over 5 years. Now, for you would say, dude, of course this is inflation. I was paying 100 rupees, now I'm paying 135. But 135 in 5 years is actually 4.5%. Unfortunately, that's the math that we have to live with. So it is that.
Okay.
True inflation, right? But then that doesn't mean that inflation is of the dosa determines your life, right? Or not everybody has a dosa every day. And
I'll interrupt here with my first thing of there is a difference between the core inflation and the headline inflation, right? Can we get into this? Because I believe that this distinction is reasonably valid for.
Yes, I think for the country, because India's basket or food inflation basket consists of 50% food. We are one of the highest elements of food because a lot of people live on subsistence farming or subsistence agriculture, this thing. So they 50% of their expenses are food.
Okay.
Another 10% goes towards fuel. Now, the difference for these two specific items, which are called primary items, are like this. When you go to the market and start to buy like onions or potatoes or something like that, you can expect a price today and you can expect a different price tomorrow. People are very used to this. They're used to saying, oh, potatoes are 10 rupees today or they're 15 rupees tomorrow. That's fine. We're used to it. We understand that prices go up and down because seasonality, production, seasons, and all that stuff. Since you're used to prices changing, you don't have such a negative impact. And when you measure inflation, you're looking at the negative and positive impacts that inflation creates. But you don't have such a negative impact of prices going up in a small way. Because onions go up to 140 rupees, governments change. That's a different thing. But I'm just saying that small elements of inflation doesn't affect you so much. So the RBI then looks at something called core inflation, which says, okay, expect food prices and maybe crude oil prices to go up and down every day. Leave those aside. Let's take the rest of it. Now, there's a big basket outside of this.
What is the rest of it?
Yeah, the rest is the stuff that you and I are probably more used to understanding. Okay. The cost of housing, the cost of clothing, the cost of footwear, the cost of education, recreation, personal services, barbers, haircuts, bus tickets, all of this stuff form parts of the other parts of inflation. Okay. This is the more...
And gold.
And gold. And interestingly...
jewelry, maybe not.
So there are elements, and one of the elements is personal care, and this personal care or household items, if you may, is jewelry. has jewelry in it. So currently, on this 0.71% inflation, the personal care element is about 25% inflation. And you're looking, why is this 25%? What has gone up 25% here? And you're looking at that and saying, well, you know what, jewelry is a good part of this. And because jewelry is considered a consumption good, it's assumed that people will spend on it. Whether they do or not is a different thing. But they don't look at it as a consumption good. They look at it as investment. So a higher prices actually makes it more attractive than less, right? So it's the exact opposite of inflation, where if the dosa is more expensive, I won't eat the dosa. Whereas if the gold is more expensive, I want to buy more of it because it might go even higher tomorrow. I want to keep that gold and sell it for a higher price. So it's an investment good. So sure. I would say at this point, this is a little wonky. So then I'm actually telling you that this 0.71% is actually lesser than it should be.
Okay. So when we said 0.7, was that just this core or was that the headline?
That was the headline. The core is actually much higher.
Okay.
The core is 4.3. And the reason why this is a problem is this. When you buy, when you're a restaurant that's selling the dosa, and I'm coming back to dosa all the time, but you buy rice and you buy rice for something and then you sell the dosa for something. If the price of rice goes up, you don't increase the price of the dosa. Because when you increase the price of the dosa, it's like, oh, dude, I have to change my menu. I have to convince my customer. I have to tell my Swiggies, all that shit. I don't want to do this. So I'll eat up the margin. And fine, I know the price will come down. But if the price doesn't come down, it stays up for a long time, then I say, I can't keep these margins down anymore. I have to increase the price of the dosa. I will increase it. And after I do, if the price of the dosa falls, I am not changing my menu price back again. So it's sticky. Once I make that inflationary change, it is sticky. So this secondary inflation or core is what the problem is when it comes to a central bank is looking and saying, is core inflation going up? I don't care if headline inflation is up or down or 0.71 or whatever. But is core inflation's trend or direction going upwards? Now, by and large, since about maybe January of this year, core inflation had been edging up. It's reached 4.3%. But in particular in October and November, it's the driving factor for this core inflation to be that high has been gold jewelry. And gold, the jewelry in general, which I think is a temporary item. At some point, it will kind of ease out. It's not really inflation, this thing. So I would say core inflation, the direction and the trend matters. Till 2 or 3 months ago, it was worrying because inflation was high. But I think since then, if you adjust out for gold prices, core inflation has also been stepping downwards. The trend in inflation is useful because it helps us understand your prices will increase, but can they increase at a lower pace instead of at a higher pace?
Okay. I think last two questions I'll ask on inflation and then we'll move on to the next topic. The first question that comes to mind to me is, look, many people who I speak to, I think I get the same reaction, but I'm wise enough not to do it on Twitter, so I don't get the reaction so violently. When you tell them that, hey, the headline inflation is 0.7%, the reaction is generally one of disbelief. And the more I think about it, it's because, say, the people I'm speaking to, and probably most of the people listening to this podcast, they have to pay for, they have a rent, and that probably doesn't go up by only 0.7% year over year. They have either a kid's school fees or college fees that probably doesn't goes up a little higher than that. Probably maybe even higher than the 4.5% number you're mentioning. They have EMIs, they have other stuff. So anything they are able to experience, which is a large part of their personal consumption basket, seems much higher than the numbers you've been saying so far, both the 0.7 and maybe even the 4.5. So that's just one point I wanted to make to you. And the second point I wanted to make is, if inflation truly is declining, I had read this book by Ben Bernanke where he talked about something called 21st century monetary policy or something like that, where he said that inflation expectations really matter a lot as well, because even if it's low, if people think it's temporarily low, it won't help. You have to all be in this virtuous cycle where you expect that this is going to, the rate of increase is going to keep coming down. So I just wanted to put both of these in front of you.
Yeah, no, so it's a very interesting and important point of how these two aspects are. Look, for instance, one of the things is what brings down prices, what changes prices. One is efficiency, of course. If I'm more efficient in agriculture, I produce more food.
Yeah.
If I have better logistics, the prices come down, they stay down. Because now if I need, so for instance, if the prices of onions go up, people start growing onions because they're aware the prices are going up, and then they, etc. and so on. Housing, all of these things, some of them are anecdotal. I'll give you an example of mine, and it's an anecdote of me as one person, right? So I moved to Bangalore. I took a place on rent in 2012, 2013 or something like that, for roughly 28,000 rupees a month. By the time it was time for me to move on, and I was just before I kind of bought the house that I was living in, I was paying the rent of about 38,000 rupees. So in about 11 to 12 years, it's gone from 28 to 38. This is not a meaningfully large increase, and it's not the 10-20% that people are talking about. However, in those 2 years, from 2022 to 2025, 3 years, you've seen a jump from the 38,000 in the same place to about 60,000 odd rupees.
No, that is enormous.
That's an enormous jump. So the people now are looking at me and saying, Deepak, come on, that rent has gone up so much. How are you saying that? But the average rent for the last 12 or 15 years is substantially, rental increase is substantially different. It's different for me. Whereas for a person living in a PG in Bangalore, is probably gone from 1,500 rupees to 20,000 rupees. So it's like a very different, set of inflation. The same thing I would say air tickets.
I think you had mentioned that one of the reasons it's gone up so much is because there was a bit of a lull in construction during COVID. Yes. So this can be a prediction. If this is self-correcting, then you may end up in a situation where prices now either stabilize or fall. I mean, fall is, of course, let's wait and see what that happens.
I mean, so for instance, rental prices are often a supply of, or a function of supply. So I was in a certain apartment, and one of the times there was a broker, a local broker, and I didn't like him because I was on rent in that apartment, and he was calling up all the owners and saying, you guys need to increase your rent to some amount. And then what happened was there was a huge prestige apartment that kind of opened up next door, which offered 25-30% lower rents for the same floor area. A lot of people from my apartment building shifted there. When they did that, the owners took some time, but they got the feedback, and then they said, come on, we can't be raising prices at a time when the neighboring one is at a lower price. So supply changes pricing characteristics even for rent. One of the problems of supply was in COVID, because of the workers not being available, in 2021 to maybe early 2022, 2020 to 2022, we had a lull in new development. And typically 3 to 5 years is a construction period for an apartment, right? So you're looking at an apartment set that should have come up by 2023 to 2025. They delayed that by 2 years. So you started to see a construction happening only in 2022 onwards. And in 2022, whatever's there will start appearing now in 2025 and go on till 2027. So in the next 2 years, you will see an increase in supply in almost all parts of India where construction is dense. You're seeing supply start to come about right now. So as new supply comes, the upward pressure on rents will likely reduce. Now you might call it AI, this 5 people getting fired and all that, but it is not so much that, because that would be a demand problem. It's actually much more the supply problem. And as supply increases, prices will probably moderate. And we've seen this in the past. Bangalore saw a massive construction increase, especially in the area that I was in, which is, HSR Sarjapur Road area, where those construction increases have been so high. Prices remain stagnant for about 10 years. Gurgaon, prices remain stagnant for about 8 or 9 years. And suddenly, in Noida also, I think...
Isn't Gurgaon where they sell the 150 crore apartments?
Also, it's now, so there the supply of the 150 crore apartments is relatively small, so you have that. But of course, now Gurgaon pays obscene prices. Their crores are
lakhs over here. Okay.
Lakhs.
I get your air travel. I interrupted you when you were going to go with your air travel example. But what I'm saying is, I'll go back to the people who I go to and say 0.7%, and they say, look, that makes no sense to me. What I want to ask you is, my expenses are going up by a lot more than 0.7%. So when you come to me with that and tell me, look, but if you average over 10, 15 years, it's actually not been so bad for you, I actually don't feel much better about it. So what am I missing?
I think, in the sense, of course, it hits you that prices are going up. They're not necessarily falling in a lot of places, but in certain cases, for instance, I bought my first car in 1997, and that time I paid, I think, 2.5 lakhs for an entry-level car. Today's entry-level car is 5 lakhs. It's not meaningfully higher than that. You're getting a lot more GWiz features, or Android Auto and whatnot. The same thing, I would say, applies to a lot of things where, like telecom prices of flights, they have not changed, but rents have gone up, housing prices have gone up, education prices have gone up. It used to be maybe 40,000 rupees a year to pay for a kid's education. Today, the lowest you'll pay is 2 lakh rupees per year, or maybe in Bangalore. So there is actually a very big differential in certain elements of inflation, and that's what makes a difference. I'll give you an example. Swiggy has probably done much more to increase your restaurant prices, because what they have done is they started off saying, we'll do this for free or for very little. Now they're taking 50% of the take rate, where the restaurant is saying, I can't afford to pay you 50%, so I'm just going to raise prices to the point where your 50% comes off the top. So which means that if you went to the restaurant directly, he would charge you a lot lower, which is also true. But so which is your inflation? Are you a Swiggy person? Are you a direct-to-restaurant person? If you're a direct-to-restaurant person, you're probably seeing a different level of inflation than a person who has been using Swiggy all this time. So that would be the differential of inflation. I would say in general, the expectation of inflation. This is the second.
That was the second one. Yeah,
is the important part.
Yes.
Now, do I expect prices to go up or down? If you ask me, the RBI conducts a survey every month, and they do an inflation expectation survey. And usually people say their inflation is higher than it actually has been. That's because people feel that inflation differently. But what RBI tracks is the trend. Fine, you're feeling X amount of inflation right now. Is the inflation looking to be higher than you're feeling right now or lower? And that gives me an indication of whether you're expecting the economy to stabilize or not. So the answer to this right now is that people are feeling that inflation is about 8.5 to 9%. But 1 year down the line, they're expecting inflation to be 7.5 to 6%. So they're actually expecting the headline inflation number to come down for themselves. This is good, because it means that people are expecting some layer of stability in prices. Now, what does this do? It says, oh, well, you know what, I'll pay less of an increment going forward for the stuff I buy. But implicitly, it also means that my income will come down by...
Will not grow as fast.
So where I was expecting a 10% increment or 15% increment, I might get only a 7.5% increment. But as a consolation, my expenses are only going up by 7.5%. So, that's a good part of what you're doing. This has a big bearing on, for instance, what you want to save for yourself for, say, retirement and so on. At 10%, your number becomes huge in the sometimes double-digit crores and all that. Yeah. But at 7%, it becomes like nearly sometimes half that number in a 30-year period.
If it's 4.5, I think it gets even more reasonable. Yeah.
So there was a show in the US called Who Wants to Be a Millionaire? Who Wants to Be a Millionaire was in the 1980s, 90s maybe?
I think 90s.
90s, yeah. And $1 million still is a decent amount of money in the US. It's because you could win $1 million as a prize in the US. In India, they built something called Kaun Banega Crorepati. When they came, Crorepati was a big thing. Now, a Crorepati will not buy you half a matchbox in Bombay. Whereas
Point
it
is
would have
taken.
bought
Point
you
is
two
taken.
matchboxes in Bombay, perhaps when it started.
started.
Yeah. So it is really that inflation creates a problem with, which is once your inflation is actually expected to be quite high, everything you need to save for is a ridiculously high number.
So the solace we should take is that it looks like we're going to enter a virtuous cycle where we don't expect prices will go up, but by at a slower pace than they have been historically.
I think
that's the best we
productivity,
can
yes.
hope for.
I think honestly, we should expect that simply because productivity is taking over. Your ability, Swiggy and all have added to prices, but to a certain extent, they've increased the number of restaurants you can get access to. So if a guy increases the price of biryani, you can go to somebody else for an equivalent biryani at a lower price correspondingly. So that logistics of choice, and hopefully, with this 10-minute instant delivery of everything, I don't even care which platform I use. I just look at who's giving me the lowest price, and my prices have come down by 5 or 10% just by doing that.
Okay, I'm hearing race to the bottom, but okay, that's a
Agreed.
separate discussion. Yeah.
Separate discussion, but at some level, it is, of course, it's also true that they're all losing money, and maybe I'm making the money that they're losing, and
Spend
that's
it well.
Yes, spend it well. Yes, but in general, I would say the problematic element of inflation is that when it rises, you feel very uncertain in life. And in general, I'll tell you, one of the things that you can't plan for 10 years ahead is because you don't know what prices will be 10 years ahead. You couldn't have planned for a 90 rupee, rupee to dollar equation if you're sending your child
Yes.
to an education abroad. When you started thinking about it maybe 10 years ago, you were thinking maybe it'll become 75. But it was, by the way, it was 68 in 2013. And the reason I remember this is because in 2013 I was like, oh my god, what's the rupee going to be when my son turns 18?
And your guess was 75?
And my guess, I had to rechange my guesses,
Okay.
right? Because till then it was 45, 50,
Yeah.
and suddenly jumped to 68, and I'm like, oh, 75 is too close for comfort, so I have to bump it up to about 85, 90, which is where it is right now. But maybe I'm wrong, and maybe by the time this podcast comes out, it's at 100. I don't know. Who knows? I mean, so
Okay. So, since you brought that up, this seems to be naturally progressing into the rupee side of things. If you don't mind, let's tackle this one
Yes,
next.
yes.
What is happening?
Yeah. What is happening is a very good question. And honestly, normal economics would tell you that if India's inflation is less than the US's inflation, and which by and large I think is true,
And our GDP growth is higher.
and our
than the-
GDP growth is higher,
And our interest rates are higher.
why would therefore the rupee depreciate, for heaven's sake? There are two. It sounds like crazy economically. This should not happen. The rupee should actually appreciate. But the answer to, and given our interest rates right now, our 10-year, the Indian 10-year is trading at 250 basis points, 2.5% more than the equivalent 10-year of the US. US 10-year is
Yes.
4.15%. Indian 10-year is 6.65%. So you're talking of a 2.5% differential for a country with lower inflation, for a country with better economic growth. This almost sounds like, how is this legal? At
Yeah.
at
So
some
I shouldn't
point?
have pretended to study economics for 4 years. It
Yeah,
made
I
no
mean,
difference anyway.
Technically, there is no economics has been So of course, economics will always have answers at some level.
yeah,
They'll say, oh, real exchange rate and some deficit and all that stuff. But here's a raw deal. India's current account deficit is $12 billion a quarter. $12 billion is of the order of 100,000 crores for an economy of 340 or 350 lakh crores. This 100,000 crores a quarter is nothing. It's equivalently 1% of quarterly GDP. When you have something so small, should it really batter your rupee so much? The answer has been a combination of a bunch of factors. One is that FIs have been taking their money out and all sorts of things that have kind of...
And can I interrupt to say that minus 12 billion per quarter, gold is part of that as well, right? And
Yes.
the same way gold is making inflation look a bit worse. Here it's making this also look a bit worse.
Yes, and technically, gold should not be considered part of the current account in my view because it's an investment good. It's like when I
people
buy
are getting
shares,
richer.
Our people are getting richer. But when we import gold, and if you remove the gold part of our imports, right, and corresponding part of the exports, we actually have a current account surplus, not a deficit. So this has been true for 10 of the last 11 quarters. However, one of the because the headline element is like this, then the dollars are actually going out. This $12 billion is not meaningful for us. We have a $700 billion currency reserve. So it's this $12 billion should be like, oh, fine, 12 billion is going out. So I'll give you 12 billion. Technically, the rupee should have been stable. The answer is no. RBI did not sell 12 billion worth. They sold maybe 8 billion worth. And the remaining 4 billion has caused the rupee to depreciate in that sense. But it's not only the 12 billion from the current account, it's also the fact that FIs have sold, FDI has been selling. So there's about maybe a $20 billion deficit. RBI has said, okay, fine, what happens when rupees come in and dollars come in, RBI increases its reserves, and when when dollars go out, RBI is supposed to give out the dollars by selling them in the market. Now, if the demand for dollars is higher, then the RBI is willing to give. So if there was $20 billion exit and only 16 billion was given by the RBI, then the fact is that the rupee depreciates. So the effectively 20 billion does go out of the country overall, but it goes out at a very much worse exchange rate for the rupee. So the exchange rate basically takes up the slack in that sense. So that's what also has happened. RBI has not sold as aggressively as people have aggressively taken money out, and that's what's also caused the rupee to fall. So it has nothing to do with inflation anymore. Now, what does inflation do? Inflation, normally you would think if India is paying 6.5% on its 10-year bond and America is paying only 4.1%, why the hell don't we borrow in America and lend to India and basically put it in Indian government bonds, because technically you'll make 2% free of cost, right? So the reason why you don't do that is because then the exchange rate of the rupee will appreciate, because now you're bringing more and more dollars to India. Every time you bring dollars to India, you're selling the dollar, buying the rupee, and therefore the rupee gets stronger in the sense that 90 rupees should have become 87 and 85 and so on. But people are not doing this. And perhaps there are good reasons for it. There's no trade deal yet. We don't know what's happening. YEVO and all sorts of other stuff.
Maybe it'll be out by the time we publish this episode. Christmas deal or something.
Some interesting point. But I feel here that economics is kind of standing on its head. The markets are not working the way they should be. And there is a lot of latent positions that are currently being used. RBI is doing a bunch of things and all that. What I feel is that currency should depreciate with the relative inflation of each other's countries over a 10-year basis. So what is happening right now is probably incongruous to current inflation numbers, current GDP numbers and so on. But I think it is more congruous towards the 10-year. So our 10-year inflation differential has been about 4%. India is at about maybe 5 or 6% inflation on average. 4.5%. I told you about the 4.5% on average. American inflation has been of the order of 1 or 2%. So the differential is about 2.5% a year. So currency should have depreciated 2.5% a year. It's depreciated maybe 4.5. But because it has front-loaded this move right now, in the next 2 or 3 years, you might see that the currency is stagnant or kind of becomes, and then the relative inflation metric still plays out. I feel that is the way forward, that rupee doesn't depreciate too much from here. Having said that, I have tried to predict this in the past and I have failed miserably. I think in my Diwali post, one of my predictions was that the rupee will go to 92, but then come back to 85.
Well, technically, you still have 1 rupee of breathing room left.
Yes, I mean, on that prediction, I don't expect it to be right, but I feel that 90 is not a number we will stay at. Okay. So either we'll go to 95, 96 and then 100, or we'll go back to the 85s, 82s and all that stuff. And it is almost entirely dependent on the RBI to take the necessary action to do this. RBI, unfortunately, has no leg to stand on when it comes to keeping interest rates so high. Because we've talked about this, the cost of capital in India is very high. How do you have inflation at 0.25% or 0.7%? Okay, even at 4.5%. But the lowest I can borrow at is 7%. So I have to pay.
Is that a housing loan, by the way?
Housing loan is now, in fact, the housing loan is cheaper than a state government borrowing. So if I take a housing loan for 20 years, it's 2025, I'll buy it's a 2045 maturing loan. A state government borrows a 2042 or 2041 right now, 15, 16 years, is at 7.4 to 7.6%. Whereas my housing loan will come in at 7.15%. So I'm borrowing cheaper than the state I live in for the same period of time, which is an anomaly. It doesn't sound right. But still, I am still paying about 2.5% more than inflation of 4.5%. which is a real interest rate. So in the sense of, if I were to put a deposit in a bank and I get 7%, my inflation is 4.5%, I'm still making 2.5% real rates. India has always had negative real rates. The fixed deposit rates were usually less than inflation. Now, this time we have positive real rates and significantly high positive real rates for a really long time. So I feel like over here there's a discrepancy, that again, an economic discrepancy of a temporary sort. But the rupee, if you ask me, there are only two choices here. It is entirely dependent on the RBI on what they want to do. If they are not allowed to let the rupee go free, unfortunately. FEMA restricts them, chains them down. So unless you repeal FEMA, nothing's going to happen. But if RBI were to say, listen, I want to use my war chest of dollars and sell it when people are going out, so that I can bring the rupee back into a more acceptable range, then I think the rupee will settle at the 85, 86 level. If the RBI says, I am not interested in their standard excuses, we are not we are only going to curb volatility. That is a little bit like, excuse me, the last 1 month has just been volatility up the wazoo, right? So you're not curbing volatility in any way. If they say that we are not going to participate, the likelihood is that more of this foreign investor selling continues and that the rupee goes to 95, 96. If they were to let it completely be free, and this is my opinion, we will go to 100 and then fall back to 80. That's because once you let something be free,
initially there's a rush out.
There's a rush out. And then when they realize that it's actually free, they come back and say, I'll bring in more money because I can take it out anytime I want. If I can fire people, then that's why I will hire people. So I think that is the true nature of the rupee game here. We will not make it free. I have given up on trying to tell people.
Your op-eds are not persuasive.
I think my opinion is Deepak Shray has a dream that one day the rupee will be free, but Deepak Shray will not exist by the time they actually do something about it. So,
Fair. Right. Deepak, turning to GDP, I have to say, I was pleasantly surprised by the number, and it seems like people in the government are also pleasantly surprised by the number. 8.2% real GDP growth. This sounds astonishingly good. I mean, but I think the disconnect is, it seems that the nominal GDP growth was not much higher, only like something like 8.7 or 9% or something to that effect. So there seems to have been a bit of a boost by a either aberrant or temporarily low inflation print. There are some concerns about data quality. But perhaps most relevantly, when you look around, it doesn't feel that the country is booming. We're doing perfectly well, but 8% feels a bit like we've just got lucky this quarter rather than it actually representing the reality. What's your take on this? Is it just a one-off for the quarter, or is 8% here to stay for a bit?
I mean, the headline numbers look good. Mosby collects them again. They reveal it 2 months after the quarter. So if you look at the September quarter, you'll get the numbers end of November. So now they've revealed these numbers, and you look at the numbers, and there is manufacturing, which is growing fantastically, 9% year on year after removing inflation. Now, just a quick primer on GDP. GDP is a complex thing to calculate. It's the sum total of all the value added. So if you have 100 rupees, you put it in a fixed deposit and it became 110. 10 rupees is the value added in this year. Similarly, if a barber gave 10 haircuts, then those 10 haircuts are value added for this year because 10 people had hair removed. I mean, you would think that's not value added, but I mean, it's somehow value is added. Yeah. So now here is the interesting part of the inflation. I mean, the GDP calculation is it's honestly a very nerdy, difficult thing to figure out. Because it's so nerdy and difficult, they tried many ways to do these things. There are 4 different numbers that you get, 4 different sets of numbers that you get. The first set is what you can measure by production. So they say, oh, well, you know what? GDP comes from where? Oh, this is agriculture. Let's go talk to all the farmers. Let's figure out all the farm things. How much value was added in farming and agriculture? X. Okay, fantastic. Now we have manufacturing. We look at all the manufacturing companies in the universe and say, how much more have you produced? How much more have you sold and all that stuff? Oh, fantastic, great. And they add up all these numbers of maybe 7 sectors: manufacturing, electricity, agriculture, construction, services of some sort. Financial services are different from personal services. Haircuts are different from bank deposits. All of that stuff. And put that together and say, well, this is the number. We've added all these up. and there's no other. Everything falls in one of these categories, and therefore we've got everything done. Fantastic. This is called looking at calculation of GDP using the production method. So you different forms of production, and then you do this. Then you're looking at me and saying, Deepak, come on, man. This dosa was he gave me dosa at 100 rupees last year, and now it's 110 rupees. So are you telling me that GDP is up 10% because of this? I'm like, you're right. Well, it doesn't make sense. It's one dosa. There was no value added by, this thing. So excuse me, can we do this and say, figure out the inflation part of things? What were the prices last year and what are the prices this year? And because you can't just say last year, because last year may have been terrible, because you had a COVID year, blah, 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 and all that. You say, oh, well, let's go back to a certain pakka year and make that the base year, and let's estimate based on that. So if 2 years ago prices were stable, we'll say, okay, that is the base year, and I'll go back to that year, saying what are these things priced in that year, and then work out the inflation number to what it is now, and therefore adjust the number. So it's called a base year.
What's the base year for India?
Unfortunately, it is 2011-12.
That does sound like a while ago.
It's like, the point where Gen Z became Gen Alpha. So in that sense, it's that Gen Alpha is 15 years old now.
You know this because of your kids, I
Yeah,
assume.
my kid was born in 2011, so it's almost like now, if he's growing a mustache, that's too far a base year.
Point is
So the problem now is you got too long a distance to the base year, so you don't know. I mean, so these are data issues that are coming in. But okay, let's say that's the thing. So you got this base year, then you adjust downwards for prices, and you say, well, you made 100 dosas last year. Now you made 105 dosas, but I don't know how many dosas you've made because I can't. I mean,
in this example, you're looking at revenue. You made X in 1 year.
I make 10,000 rupees in 1 year. I made 11,500 rupees in the second year, but I know prices have gone up 10%. So while nominal GDP is up 15%, since prices are up 10%, real growth is only 5%.
Understood.
So that is the idea. So now, because of this, I can figure out the inflation, which is called the deflator, nominal to real. Nominal is what I measured. Inflation is what I've estimated, and then the deflator is the inflation in this case. Our inflation, because of this deflator, is only some 0.5 or 0.7%. Now this sounds ridiculously small, and it is a problem because your government takes tax based on nominal GDP. It can't tax real because inflation, if your salary goes up 10%, they won't say, oh, you know what, forgive the tax on the 10%, just pay me on your base salary. I mean, come on.
Sure. I wish.
You have inflation, I take that inflation as well. That's you're going to pay me higher tax. So it's in that sense, government inflation expectations determine government revenues. So if the government expected nominal growth to be 10%, they got only 8.7. Now they're like, oh shit, how do I finance myself? Because now I have lesser tax collections, right? So this is a problem. Second layer is that I've got these two elements of constant and the base year being so far away, all those data issues. Then I have another layer because no economist wants to be said, have you measured GDP only one way and you only measure it two ways because you've measured it with inflation?
We're serious people.
We're serious people here. Can you please get more ways? Yeah. So they decide to add two more ways to do this. So the two more ways are, there's something called estimates using consumption. Okay. They say, well, you know what, instead of saying how much people are producing, can we just go back and say how much people are consuming? So instead of, so I'll say, oh, well, how much is the government spending? Because I know where the government spending is. How much are private companies, private individuals spending? So they're buying stuff, they're paying GST on that stuff. All of these things are added up. There's some estimation elements involved in this because haircuts, you don't know, you estimate people have so much hair, so many bald people, etc., etc. So now you do all of this stuff and then you work it backwards and you say, well, there is something called government expenditure, there is something called private expenditure. Private expenditure in India is about 60% of GDP. Government expenditure is 10%. So that's the two elements. Then you have something called investments. Investments are essentially when I do capex, I construct a house, all that stuff. That's money that goes into investment. It's not consumption, but it's investment. So I'm buying something that I think will yield more value in the future. Then there's something called change in inventory. So I, as a factory, I used to keep 500 kgs of something. Today I'm keeping 600 kgs. Those changes of 100 kgs extra is value added for this year. So therefore it's part of GDP. And now same thing, they have imports and exports. So imports are negative, exports are positive. So exports minus imports adds to GDP. This is called estimation by consumption, the consumption method in that sense. And this estimation turns out another number. So I did the production based, then I did the consumption based, and then I said, oh, well, there are two numbers. Now, what do I do with these two numbers? There are differences between them. I add this thing called discrepancies. Now, usually a rounding error, a small number, and all that stuff. And because I can't just measure consumption method in one way, I also reprice those things to 2011-12, the same base year. And then I have now estimates of production at constant prices, which is at the base year, estimates of consumption at constant prices, all the stuff. The words are different, but whatever. And there are these discrepancies. Now I have 4 different measures, right? Sure. Current prices, constant prices, production, consumption, or whatever.
Average them out, maybe? No.
So you measure, you say, well, both the numbers have to add up to be the same thing. So you have this discrepancy element balancing them out. Now, usually the discrepancy element is really small. But this time the discrepancy element is some ridiculous number and is a weird situation. Okay, to first work it backwards. Things like this 8.7% versus 8.2%. Sounds crazy, but last time we were at 8% growth was 2015-16 or so. That time inflation was, I think, 5 or 6%. So when you have 5 or 6% inflation and 8% headline real growth, the economy is actually growing 14%. Yeah. Then you can feel it.
Yeah.
Oh, everything looks like it's growing strongly. Now, because inflation is only 0.5%, you don't feel it as much because you're like 8.7 nominal does not feel like real growth, right? The same thing now, I would say this discrepancy level is either a rounding error or a big warning in your face. If I'm telling you the discrepancy between production and consumption on a real basis, maybe 1 or 2%. Now, beyond 1%, it starts worrying you. At 3%, which is where it is right now, you're like, excuse me, why are we having 3 or 4% or 5% as discrepancies? Why can't you go and measure things better? Second part is, here's a very interesting part. Because you now have this constant base prices and you have current prices, you would imagine that discrepancies are the same in both, right? Because both have been rebased to the same number. But the discrepancies in the Q2 are a negative. That means the production estimate is higher than the consumption estimate by 240,000 crores. Whereas on the constant prices, which you subtract inflation, the discrepancies are where the first one is lower. So the signs of the discrepancy are different. And that again sounds like, excuse me, what the hell? No, we've never had a time in the past when it has been so large and the signs are different. And this is the worrisome part, because then are these really discrepancies, or is it just that we haven't collected enough data or collected data right? So it's not just the base year, but the size of these discrepancies that make you feel that 8.7 is not 8.7, 8.2 is not 8.2, and possibly we are looking at something where if the core inflation that we talked about earlier was 4.3%, we might actually be only growing at 5 or 6%. The current prices number is actually accurate because that's the one that we can measure. That 8.7% is accurate, but the real number, if you adjust for really,
maybe a bit lower than 8.2%.
Yes.
Fine. Okay. So I think I got some sense of like the issues we're facing on the data quality side, and hopefully that will get adjusted or figured out over the next year or so. But just even sticking with the 8.2%, what's driving that? Like, who is growing? I mean,
so manufacturing is doing really well in that sense, even on nominal and real basis. We're talking 9% increase.
People say it's because front loading of exports before the tariffs kicked in.
Possible, but that would have shown up in exports.
Okay,
it didn't so much. The export numbers were not as great as the import numbers. And it's possible that, of course, we did some front loading at some point, but this was manufacturing has gone up primarily because our manufacturing is mostly for ourselves. At each level that we have seen an increase in manufacturing, it's because of lower taxation, changes in elements, changes in logistics and so on. But it's also come in well because there's been many years of stagnation. So last year, for instance, manufacturing increased only 2%. So the lower base effect also, kind of affected. The other one was personal services, haircuts, this, that, all the personal services that you can get have gone up by nearly 9.5% or so. If you look at financial services, the financial services, some part of it is also that people are borrowing money, and people are using that borrowed money, have to pay a higher interest rate to pay it back. So typically people pay 10, 14. India has a very high cost of capital. So India people are paying 10, 12, 13, 14% to just pay back the regular loan. This has implications because there's not really value added. Of course, there is value added to the NBFC that's perhaps, but you're thinking this is, if this loan is not for productive purposes, then it does not mean more money will come downstream. It is just that people are using it for consumption, like maybe finance a wedding or do something that is very, very temporary in nature. And it will not result in something great in the future. Now, this worries me because it is possible, because last year what had happened was that there was a huge amount of growth in both credit card outstanding and bank personal loans. They were growing at 30-35%. RBI clamped down very strongly on this. And a lot of loans that were given out at that time were told that you cannot increase the loan book anymore. So a lot of these loans continue to be serviced and so on. So it's possible that people are just borrowing just about enough, and people are, the RBI has eased up on that in this particular quarter. So it's possible that some part of this growth has come from people just refinancing their own loans to pay that extra 10 or 15% that they're paying on the loan amount. So it's not necessarily a good thing. Okay. I would love the manufacturing element of it, but not so much.
The financial services one, you're a bit skeptical about.
The financial services, the growth in unsecured loans has been very high, and we've got, so I would love the fact that personal services is growing up, but financial services does not necessarily mean good quality GDP. It could be, in fact, that I have chosen to, instead of borrowing to build a business, I'm borrowing to invest in the stock market and maybe losing money as well. Because last year
probably,
has been rough, right?
No one was borrowing money, is probably borrowing to buy Nifty 50.
Yeah. Right now, that the CEO of a very large electric company, two-wheeler company, which is listed in the markets, apparently pledged 300 odd crores of his stock.
Okay.
And in the last 2 days has had to sell to be able to meet margins because his stock was down 50% from the top. So people have borrowed.
But this happens always. Yes, but I get your point.
So it is people have done this. Though I would say what is interesting here is that the credit growth in the economy usually determines how fast the GDP will grow also going forward. And credit growth has been very slow. And one of the reasons it's very slow is because this personal loan thing went up like crazy. But corporate credit and investments by the corporates has come down because India's cost of capital is too high. So they said, listen, let's repay our loans. So individual loans went up quite a bit. Real estate went up quite a bit. Now again, this is not much value add. So if you build a house for 100 rupees and sell it for 300, and then tomorrow are able to sell it for 330, to me that's just inflation in housing, because you're not getting a better house or more houses for the same amount of money. But this counts as some kind of value added in the overall part of the system. I would say in general, the financial part is the worrying part. Manufacturing part is a good part.
I think it's a good time to intercept. And so, look, I was looking at some stuff. There seems to be a whole bunch of deregulation happening, either in response to political stability or in response to the US, India struggles on the trade imbalance conversations. So with that, do you think this 8% type growth or something close to this is here to stay for the next couple of years?
I hope so, because I think India is extremely ridiculously under-indexed in terms of manufacturing. I'll give you an example. We have a lot of coffee shops.
Like six, within a stone's throw from our house.
Yeah, which don't throw the stones.
Yeah, but point taken.
But even if you went into these coffee shops, great place, fabulous furniture, amazing coffee machines, amazing equipment and all that stuff. 99% of this equipment is not made in India. 99% is not. And it's not for the fact that we can't make it in India. We just don't make it in India. So we don't make coffee machines. We probably don't even make the coffee. We probably import
No, I think the beans and the people
are from here, yes. So beyond this, the coffee, the milk is probably from India, but the milk frother is not from India. You got a coffee roaster that's not from India. It's made in Italy, etc., etc., etc. But it is not complicated to make these machines. It's just that they're not made here. We are one of the largest textile exporters in the world. We don't make a single sewing machine. Why would you not own part of the ecosystem that you this thing? I've heard that India is one of the largest airline ecosystems in the world now, because we fly a lot and stuff like that. Except all the software that is being used to control the stuff that happens in terms of bookings and etc., 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 is not software that was made in India at all. And
Like, a couple of companies abroad. Yes.
So we are the largest IT service provider in the world, and we don't own the software, any of the software, any of it. We actually now finally own banking software that's used in India, but we don't use. We are very early in the manufacturing part of the game, and sometimes it's just laziness, but. Let's say just physical things we just don't make enough of, and we should make more of them. And the tariffs from America are going to force us to do that, because otherwise you'll be importing all this stuff from abroad, and if don't have enough dollars to import, you're going to have to make for yourself. And I think that is important, because the more you make for yourself, the more likely you will improve the product that you only do for yourself, and you'll increase. We've got some great innovative products that we've built. I mean, for instance, 10-minute delivery is ridiculously good, and it's not okay. Maybe you can't do it in the US or in the West, but it can be replicated in a lot of countries where relatively unemployment is high and labor is relatively cheap. You could get a model like this where people are able to get, because these guys, it's a logistics problem. If you can solve that logistics problem, you can deliver a lot of things very, very quickly in any country, except it hasn't yet been exported as a model, right? So it's only in India. The same thing about UPI. UPI is a fantastic thing. It's working. It's like way bigger than Visa and MasterCard in India, a factor of 10 or 12, except it hasn't been replicated elsewhere. We haven't been able to take it out. So we do have some layers of innovation that's happening. In manufacturing, maybe it's early days. We're starting to build CNC machines. We're starting to build more things that are coming out. It will take us some time to catch up. Because of that, I feel GDP growth can still be 8% plus, meaningfully on a real basis, if inflation is maintained at a low level, simply because as more and more manufacturing happens, the manufacturing ecosystem will absolutely explode from here. We will see a lot more places where top quality items are being made by Indian manufacturers, made available in general and this thing. And so if you look at China's GDP growth, China grew GDP by more than, I think, 10% or 8, 9, 10% for nearly 14 or 15 years at a stretch. So it's not impossible.
But it'll take some doing.
It'll take some doing.
Yeah. I think just since you brought that up, I think I'll just bring up this anecdote. Earlier this year, once when I was just reading articles about China and the economic situation there, they were saying there was a time when the foreign manufactured cars were truly the most aspirational ones, I guess, Audi and so on. But over the years, people have just stopped caring because their cars became good enough. And maybe one day that'll happen here, fingers crossed.
I mean, I'll tell you, I drive an XUV 700 or 700 as they call it, and it's a Mahindra car, and it's not... it is so good that I feel that in a lot of cases, it drives like a non-Indian car, a car that is from abroad. Of course,
so hopefully we'll stop using that expression.
As in to say that it's something foreign is the one that... Yeah. I mean, Indian brands used to name themselves with foreign names. Like you used to call... there's a brand called Peter England. This sounds like it's British, but it's not. It's an Indian brand. It's by Madura Coats, or was by Madura Coats. I don't know who it is by now. But it was invented. So you saw that the bikes of India or the cars of India were showcased in Australian and other environments, whereas the Hyundais were actually trying to call themselves Indian cars and saying that we actually work in India and so on. So there is a lot more of this thing that India doesn't make great stuff that is happening, and maybe that will change as time goes by, but we do make some great stuff. Like for instance, in sanitary ware, some of the brands we have are actually quite good. In fans, BLDC fans, some of the Indian brands have actually done quite well in terms of building their brands on it. Of course, they don't own all the ecosystem. They still use like Chinese materials and a lot of stuff in there. But yeah, India is focusing on rare earth metals now, on mining now, Hopefully, we'll be able to build our own sensors based on the magnets that are being produced from, because we don't have access to the materials that could allow us to build those magnets. But magnets are used in things like fans, and we had to import some of them whenever they were used in certain kinds of applications. Magnets are used in sensors in cars and so on. So all those things we have to import. But as India produces this, the use cases for Indian manufacturing increases dramatically, because other countries say, well, why are you importing so much of our magnets? And they refuse to give you magnets. China did that. And when they did that, you're like, oh, wait, our whole car production depends on imports of magnets from China. Why can't we make our own magnets? What is in that magnet? Rare earth. Well, do we have rare earths? Yes. Why don't we do anything about them? We don't know. We set up a company in 1955, and to be honest, it's not done that much till date. Well, let's fix it. And then that's what happens. So I think we are in that phase of let's fix it. And that let's fix it in government terms is let's fix it sometime in the next decade, because everything takes that much time to kind of seep into that ecosystem. But if you let the private players in, they will go and figure it out, they will play. And I know people don't like the fact that, oh, why is private players taking everything? But guess what? All the great stuff that you're doing, almost all of it, has come because of private players. The banking system improved because of private players, not because of the public sector banks. Now they're catching up and they're trying to do things. But when the market was only public sector banks, dude, you could not. I mean, you had to beg to get into that branch in the first place. So I think these improvements are going to cause our GDP to jump tremendously in the next few years. It will seem unseemly, but I don't think in the future that it will look so bad for us right as it is right now, because we are feeling like nothing's happening and they're showing us 8.2%. And that's because I think these data discrepancies and all that exist. But tomorrow, I actually believe there's potential for real 8% GDP growth with low inflation. We do need to reduce interest rates. We need to figure out what this rupee equation is. Are we controlling it or are we not controlling it? Just figure out one of the two. Don't do this, oh, we'll control it if it goes down, or if it does not go down, or if it goes down too much, but I'm not sure. That kind of thing is dangerous for India.
Okay. I've left my last and most interesting topic for last. I don't think it'll take very long, but it's definitely quite exciting. On the stock market front, as I said, everyone who isn't the Nifty 50 isn't feeling very good this year. So what's your take on that? What is responsible for that situation when there are enough positive signs, whether it's inflation or GDP growth, there are enough positive signals. Even with the rupee weakening, then why aren't our export-based companies doing particularly well stock-wise? That doesn't necessarily seem to be the case. So what's your take on the stock market? I mean, just a bad year, or is there more to it?
I think it's a bad year because we've had a lousy kind of a year, in terms of performance, in terms of earnings. Maybe the valuations went up a little more. All those are factors, and foreign investors have been selling. What is wrong? I don't know whether the answer is macro data, stock markets, foreign exchange rates, etc., etc., etc. I think part of it is that mid caps did really well last year. Maybe they overshot some of their valuation expectation in 2024. And there is a lot more supply of new companies this year through IPOs. Yeah. A lot of this supply has been absorbed by mutual funds who have been receiving SIPs. And maybe that is what has kept some companies afloat, but almost naturally has not resulted in new money being added to the older companies, because those older companies maybe were overvalued and they're correcting. Like I told you, an electric two-wheeler company fell by 50%. There was a company making semiconductor fabs. It's down 50%. And so there's lots of reasons for these things as well. If you look at small and mid caps over 3 years instead of the last 1 year, then you're like, oh, wait. We're looking at about 18 to 19% growth averaged over the last 5 or 7 years. So the mid cap index and the small cap index on a 3-year rolling basis has done substantially better than what it has in the 1 year. So it's like, oh, maybe small caps go through cycles, and this is the down part of the cycle.
I've heard this one before. Yes.
So at some point. Now, the issues are that the small caps have the maximum capacity to expand. I think that is where the maximum opportunity is. Because they are relatively small and nimble. The larger companies often look at opportunities and say this is too small for us. So you take a company that is 10,000 crore or 15,000 crore in revenue. If you show it an opportunity to get 5 more crores, it's almost like, is this even worth my
The
time?
coordination effort will be too high.
Too much. Similarly, a fund which has 10,000 crores in size, if it gets a 5 crore opportunity to invest into a company, is probably saying, yeah, I mean, if it doubles also, it's not going to move my needle, right? So whereas small companies, small funds like us who have 300 or 400 crores in our AUM size are more easily able to accept such opportunities. So I think it's the small players that will benefit a lot more in this going forward. And they're the ones that have corrected the most as well. Their GDP rates their growth rate will be even higher than the GDP in that. The second layer is that what is inefficient in the past has now started to get efficient. GST is one level of efficiency because earlier it was a pain to pay, VAT, service tax, blah, blah, blah. Now you actually have everything rolled into one. You get inputs, outputs. You're starting to see the benefits of GST flow into the system.
They've also brought down rates a bit.
They brought down rates a bit in October, September. And this thing is big. In the US, companies in the retail space have grown up the maximum in the past, right? Now, efficiency is very, very critical to retail. So DMart came in, it made things efficient, and they won a significant part of that game. I think that has also become one of the largest players. So in the 1990s, Walmart grew up like massively and it kind of took over people. In India, it's Amazon and Flipkart perhaps. Both of them are not Indian owned, and that is a problem. But how do you solve that problem? You don't solve that problem by saying, I'll get a third player or I will force them to become Indian. Their lunch is currently being eaten away by the Zeptos, Blinkits and Instamarts in that sense, because a lot of stuff is now flying into the 10-minute delivery stores. Fine, everybody's losing money, but so is Amazon in India and so is Flipkart. But to a certain way, what is happening over here is the losses are being democratized across these 4 or 5 and they're trying to get into this. However, while these may sound interesting and maybe not be great because they're not profitable companies, there's a small town guy with 4 showrooms. He's expanding into a 40 showroom setup. He's listed on the markets and he gets a tremendous amount of the growth because he in that growth from 4 to 40, he's using some digital channels, he's doing some moves and all that stuff. His business grows maybe 20x more. Versus for an Amazon or this thing and all that stuff, even a 5 or 10% growth would be quite good. So in that sense, I think it's the smaller players that will benefit more from this rise in GDP production, rise in India's growth and consumption and all that stuff. I would say the stock market does not like that right now because these guys got overvalued. But if they're able to demonstrate their growth in their actual numbers, which will still take time, I think the valuations, some of these companies will not just grow into their valuations, they will grow a tremendous amount more as well. Whether it is electric two-wheelers, whether it is companies that are perhaps early in the AI and the robotics and the factory automation spaces, there will be a lot more of these companies that come in. Again, one of the big example is India. Conveyor belts are one of the largest things that all our factories carry stuff around using conveyor belts. We hardly ever make conveyor belts.
Not spent any mind cycles on this, but yeah, that sounds about right. Yeah.
Our airports, we have airports everywhere. The conveyor belts that are in the airports are not made by Indian companies. It's almost strange because we make steel. We are the 4th or 5th largest producer of steel. We understand how conveyor belts work, obviously, but we don't make them. So in that sense, I think the guy who's going to make the conveyor belt is probably not going to be your, Reliance Industries or somebody like that. It's probably going to be a small company that identifies that opportunity and says, I want to target this. And I think this will become big going forward. So that is one thing that, comes in. And I feel that if we are able to keep a steady exchange rate, we don't need it to be appreciating or depreciating. If the exchange rate is more steady than anything else, then things will move in the direction that allow more of our domestic companies to progress, and we should reduce the cost of their capital. We already have tariffs. We were one of the largest import tariff countries forever. We've always been that. I don't think we need to change that. I mean, we should eventually when we get competitive. But in many cases, we it is too early to be competitive, and because other countries are for instance, in solar, when you make solar panels, India as a country can make solar panels, but China is subsidizing the solar panel industry to the point where they're even making losses and trying to dump all over the world. This is great for a guy setting up a solar plant, but when China decides to raise prices because of whatever, the entire solar project is screwed, because they don't have any competition now that the Chinese guys have eliminated everybody else. So you do want that competition to be set up in India. The defense guys have realized it. The defense guys have said we cannot afford to depend on China for our defense needs. Like America has discovered very recently that it depends on China for its defense needs, because they have certain rare earth metals which are used in missiles, without which the missiles cannot be manufactured, which China controls. So America is like, wait a second, I am almost like enemy of China, and they are supplying the material. I need to build deterrence from them itself. I mean, in the first place. So that realization India suddenly had in a mega way. Oh, wait, 80% of everything we did was imported? Really? From the countries who are sympathetic to our enemies? Really? And that is really kind of hit us really hard. And at some point, so it's been 3 or 4 years, but it's a long game. And maybe initially all of us in the stock market got so enthused that we're like, oh, let's go and overpay for these companies right now. But I think paying for these companies has been a good idea, because if they succeed, we will actually get a lot more Indianization of the goods that we want, and eventually these companies will be valued at a lot more. Maybe I should not make that example of an Nvidia or an Amazon or something who has made losses for considerable amounts of time until suddenly they're ridiculously profitable entities. But I feel India will have a few of these as well, who will be overvalued today, but will be tremendously undervalued based on their growth potential.
Okay. Deepak, so SEBI pushed out some new rules last night and they've impacted TERs, expense ratios, and so on. So I looked up this morning and all AMC stocks seem to be going up. So I'm guessing it was positive news for the mutual funds. Can you tell me what were the new rules and how are they impacting everyone?
So there was a consultation paper that was out, and they were talking about a lot of these rules. They have said in the press release that they have approved most of these changes with some modifications. Let's go through two of them. They're the ones that are most important, right? So first one is that the TER, which is the total expense ratio, has now become two different interesting terms. So one is a BER, which is the replacement of what this current total expense ratio, called a base expense ratio. Now there are limits to the total expense ratio today. There are limits to the base expense ratio tomorrow. Whenever April 1st is when I think the new rules come into effect. And the new rules haven't actually been announced. So we're seeing from the press release what it means. The base expense ratio is a new concept which has come in. Now, why is it complicated? Because the total expense ratio had a lot of jumbling inside. They said, oh, you know what, if you're paying someone 100 rupees and there's a GST of 18 rupees on top of it, you should assume that your TER is 118. But obviously, we don't have any control on the taxes that are being charged, right? It could be 18%, could be 12%, could be 25%. So the answer they said was, you know what, I'll give you restrictions, but I'll give you restrictions pre-tax. Now, you were, of course, paying maybe 18 basis point, 15 basis point, a little bit more. So I'll reduce the base TER limits by 15 basis points. To give you an idea, currently it is up to 500 crores, you can charge 2.25%. Beyond 500 crores, but below 750 crores, 500 to 750 crores, you can charge 2%. So there is a blended rate. So if you have 650 crores, your blended rate may be something like 2.17%, or something like that. So there's a blended rate for each fund, and each scheme is, measured like this. This is an equity scheme. Debt schemes have a lower ratio and so on. So they've reduced by 15 basis points appropriately across this entire enterprise. Now, there was one weird thing that was there, that is currently still there. The current situation is that GST is included in all expenses except the management fee. The management fee, the GST is separate. It's outside of the limits. So management fee is basically, given a little bit of a better hand. The new rule says everything GST is outside, but everything is down by 15 basis points in terms of limits. Now, what does this mean? I'm like, okay, this has to mean something. If you are a broker who's doing commissions, the mutual fund is paying you commissions. If this mutual fund was paying you 1% as commissions, it worked out as 0.85% or 85 basis points to you, 0.15% or 15 basis points to the government as GST.
Okay.
Sounds great. Now, this is new is going to be 0.85% to you is recorded in the BER. The 15 basis point is separate. It will be revealed as something called a TER, but not, there's no limits to it. Now you might say, does this impact anything? Well, you know what, let's consider you're a fund, and in that fund, you are getting this 1% commission, and I am the manager and I am charging you 0.8%. So the total expense ratio is 1.8%.
So
this is the maximum limit. Yeah.
In this 1.8%, 0.8 is earned by the manager. There's a GST which is kind of hidden. 15 basis points is GST on the broker commission, which is part of this, and 85 basis points is what the broker was getting.
Yes, correct. So it's 0.85 plus 0.15 plus 0.8.
Okay.
That's the three elements. If in the new, when the new rules come in, it will be like the limit of 1.8%, which was the maximum limit allowed, the blended limit allowed, will fall to 1.65% because everything's down 0.15%. If it falls to 0.65%, 1.65%, how does that go? It is 0.8% to me, which is what I was charging, and 0.85% to the broker, which is what the broker was getting. So the distributor was getting. The distributor commissions remain exactly the same, and GST is outside the ambit. So this
everyone
sounds
is
like
this neutral.
exactly.
Yeah.
But what if I told you that, listen, my fund is really small, and I was giving 1.5% as commissions. If I was giving 1.5% as commissions, assume that for the same 1.8% limit, 1.5% was commissions and 0.3% was what I was keeping. Sounds great. Sounds bad, but a lot of small funds work like that. When you have 1.5% commissions, it's actually, the math works out to 1.27 to the broker, 0.23 to the government as GST, and 0.3 to me as the fund manager, as the manager, right? So if you think of this and remove the GST element, I get 1.27, which is going to the broker. I get 0.3, which comes to the manager. If you add them both, it is 1.57. As I told you in the earlier case, limits are down by 15 basis points. So the limit has become 1.65, whereas my math has only added up to 1.57. So I get an 8 basis point extra headroom. That headroom, you might say, goes to three people. It's either the investor, where you can say, listen, I can charge 1.65, but I'll charge 1.57. Now, typically, a smaller exchange ratio by maybe a few basis points in an equity fund, people don't care. You're charging me 0.05, 0.08% less. Like, who cares? Yeah, just earn me that.
I mean, if that is what my decision is going to be based on, I don't want to be part of it.
Yeah, I mean, it's like, it sounds too small to make a difference. Having said that, so since the customer doesn't care so much for these small numbers, who gets the benefit? It could be two people again. It could be me as a fund manager says, I will get, I was charging 0.3, I was struggling for my life. I'll charge 0.37 and I'll be slightly happier. Or I could go to the distributor and say, listen, I was giving you 1.27, I'll give you 1.35 instead. So maybe you'll get me more business. Okay. So I incentivize the distributor by giving more. So it could be an increase in distributor commissions. It could be a reduction in total fees that helps the investor. Or it could be the increase in management fees by the AMC itself. One of the three. Or in fact, a little bit of all three. It could be a combination of all of them.
So everyone could be a little better.
Little bit.
But from the sounds of it, though, it seems that the customer or the investor in the mutual fund might be worse off.
I think in terms of total expense ratio, if the distributor commissions were to go up or if the AMC commissions or management fee were to go up, he would hurt.
Yeah.
But think of a large fund which cannot charge 1.8%. It can only charge 1.2%.
Okay.
And the distributor commissions were only 0.5 or 0.6%. Now, in a 0.6% commission, only 8 on 10 basis points is the GST. But my limit has come down by 15 basis points, which means that instead of adding headroom, you've taken away headroom. So that means either the AMC has to make lesser money or the distributor has to make lesser money. I think it will be a combination of both. They'll probably share it half and half. But the larger funds, the larger schemes are the ones that are going to see a problem, because they are the ones which pay distributors a lot less money and they're at hitting limits. Debt funds, there will be no difference, because debt funds anyway don't pay anywhere close to the limit, and therefore there's going to be no change. But you'll see in equity and hybrid funds that the larger funds have to renegotiate with their distributors. The smaller funds probably have more headroom. Sometimes some AMCs, all AMCs have both big and small funds. So they have some ability to kind of, mix and match between the two.
So overall, there's a little more money available for everyone, and there's more money to distribute. It might be coming out, some of it from the customer's pocket, but the numbers weren't very high to begin with, and this is perhaps the first big change in a way of bringing down prices overall in the years to come. So makes sense. Deepak, so SEBI came out with the circular last night. It's been in the works for a while, but the reaction has nonetheless been a bit surprising. So they've come up with some new rules. There used to be a TER, now there'll be a TER which is higher and a BER which is lower, which is a new concept introduced. And when I looked at the markets about 10 minutes ago, I saw that all AMC stocks are up, and quite a bit at that too. So who is this helping? I mean, this seems to have been a new rule. I would have thought it would be negative for the mutual fund houses, but that doesn't seem to be the market reaction. So can you tell us, well, let's start with what are the changes that have been made, and who comes out in better shape and who comes out in worse shape?
Cool. This is actually interesting, because mutual fund industry, the rules have been set up as a complex set of rules. We know we run a mutual fund, so we are therefore very aware of the complexity of these rules. One of this is that the financials of running a mutual fund house involve an AMC charging a certain amount of fees to every scheme of every mutual fund scheme that is available, and that there are distributor commissions that play a part in one part of those schemes, which is the regular plan. So these are two things. The AMC charges a fee and the distributor charges a commission. There's a third part, which is some extra charges which the fund has to bear on its own, like transportation, courier, things like that here and there. So those are extra fees that are also part of this whole thing. Now, the way the TER was structured in the past, and there was only one word called TER, or total expense ratio. Actually, it was total expense ratio and base total expense ratio earlier. But ignore that. We used to reveal a total expense ratio number. There were limits on this number. Now, this number could maximum be 2.25% if your AUM was 500 crores or less. Okay. So if you're 500 to 750, then the first 500 you only charge 2.25. The next over 250 you can charge only 2%. The next 250 you can charge, or next 500 you can charge about 1.75. So at any given AUM of a scheme, there was a blended total maximum TER you could charge. Maybe it was 2.17% if you're 670 crores. If you are, and this is for equity schemes, debt schemes was correspondingly a little bit lower. The complexity here was that when they said you have an expense, they included the GST and all the taxes and statutory levies included in that. So which means that if I paid, for instance, 100 rupees for something and 18 rupees was service tax, and it was supposed GST, 118 was part of my total expense ratio, and this was limited by those limits I talked about, right? But there was one expense which was outside the limit but could be still charged. The management fee by the AMC itself. The management fee by the AMC was, let's say you charged 500 rupees as a management fee, or let's say 1% as a management fee. Then only 1% was considered as whatever added to that limit. So it was 1% management fee, 1% commissions. That was added up. Distributor commissions included GST, but the management fee was not including GST. So you would pay 2% plus the GST on the 1%, which is 2.18%.
So fine. So far, this is fairly intuitive. The GST on your management fee was not part of the TER.
Yes,
so,
or is not.
Is not part of the TER. All right.
So then board meeting, they announced a change to the regulations, and one of the, we haven't got the final regulations out. They've said we're changing the terminology. So a little bit of SEBI Scrabble here is that TER is a total expense ratio. Now there's something called a base expense ratio called BER. BER is...
we'll come to it, I guess.
We'll come to it in time. But one of the things is that whatever was called the TER earlier, it's just BER. But can we please take the statutory levels, GST, etc., out of this? So that is the new BER. And this new BER has the limits because it doesn't make sense to have, because tax rates can keep changing, new fees can be added, new taxes can be added. As long as it's a statutory levy or a tax, we don't want to include it. Now that part now it's become important. Now, obviously, if you're telling me that I was paying a 1% commission and that 1% commission included GST, how much am I actually paying? I'm paying 0.85% plus 15 basis points, 1.15% as GST. Now the new limit will only allow the 0.85% in. Does that mean that everybody can charge more? The answer is no. They said this is correspondingly, we will reduce the limits by 15 basis points. So what was 2.25 is 2.1. What is, so things like that. So the slabs have changed.
But the slabs have changed. Do we just now have two new sets of slabs? One slab is all the payments without things like GST and other statutory payments, and the other one is that plus these various payments. Is that the only two difference?
That is the first layer of the difference. The second layer of the difference is there are two elements that were absolutely unknown to you today, or are unknown to you. You don't know how much brokerage the mutual fund pays to the brokers that it uses to actually buy and sell shares or securities. That brokerage is limited to 12 basis points. The new rules will now limit it to 6 basis points, but the 12 basis points included the statutory taxes. The 6 basis points is without. We'll come to this. But essentially, this will be revealed in the total expense ratio. So this was 12 basis. The brokerage that could be paid was as much as 12 basis points. Now it has been reduced to 6 basis points. It has to be revealed as part of this TER and an STT, which you pay in general, which is for about 10 basis points or so on, for every buy and sell of a stock. This will also be revealed as part of the total expense ratio.
So TERs will now go up and BERs will look just a little lower than they were earlier. So you're going to get some sticker shock now, actually, if you look at TERs.
If you look at TERs, I think the idea now is to start looking at BERs rather than TERs, and the BER has to be an educative experience of what the management can control. Of course, if you use a strategy that often has to change stocks, I'll give you an example, an arbitrage fund. An arbitrage fund will buy a stock, sell a future. Every month it has to rotate the future. The future has a brokerage fee and an STT associated with it. Both of them will appear now. So let us say the brokerage is, I think it has been now limited to 2 basis points. So brokerage is 2 basis points, statutory levy is another 1 basis point, and there's a buy and there's a sell. So you do 6 basis points here, and then there's an STT of maybe 1 basis point. So 7 or 8 basis points per month. That is 84 basis points per year. 7 basis points per month is 84 basis points per year. Assuming you're just rolling over the future every month.
That sounds high.
And currently the TERs are showing as 40 basis points. If there's an 84 basis point additional charge on top of this tomorrow because of the transaction fee getting revealed as part of TER, you might look at this TER and say, this is crazy.
Well, I would certainly like to know. I mean, there's actually 1.2, but it is the price of existing. I mean, I get it.
Yes. And if that is, it is not like, listen, somehow the world structured itself in a way where everything was ideal and I didn't have to pay this 0.84%, I would get a better return. The answer is no. Just to make the transactions that make your returns happen,
you have to do this.
You have to pay this. And there's no other way. An arbitrage fund cannot not roll over its futures. It cannot.
This is the price to pay. So you could say the 0.4 was perhaps a little misleadingly low, but and the 1.24 will therefore look a little alarmingly high. But these both are real and existed in the past.
Yes, and the only thing that I would say is that in your mind you should say that there is a controllable element which can be reduced,
which is the BER.
Which is the BER. But there's an uncontrollable element in form of these transaction costs, which sometimes are a function. So, for instance, does a manager not churn his portfolio
to make the TER look better?
To make the TER look better. But what if that return drops your return by 4%? So to give up a 1% TER, you've dropped your return by 4 or 5% a year. What's the point of that?
Yeah, correct.
So, and anyway, I'm going to show you my NAV after the TER. So it's not like...
So the NAV you saw was after everything anyway.
So even today, you're paying that 0.84% in the arbitrage.
You're just not
seeing it. It's great to see it. But in the end, compare people based on returns after the expense ratio, not the expense ratio itself, because they can't really control that meaningfully. The TER. The BER is something they can control because they can control the commissions they pay and they can control the management fees they charge by themselves. There's some small elements which they can't change, but by and large, all these fees are negotiable.
Okay. I was thinking there are probably 4 major players in the mutual fund space. There's customers/investors. There's brokerage firms who will help you like do the trades. There's distributors who help most people get their customers. And then there's the fund management house, the EMC itself. So with the new rules, who of these players is better off and who is worse off?
So let's start with the first part. The first part is simple. Is the investor better off? Okay. The answer to it is there are 2 rule changes and we'll have to evaluate the value of both. Now, let us say there's a very small fund. The small fund by nature can charge a higher fee on the regular plan. So if you're a regular plan investor, does it change anything for you? So the answer goes to, okay, well, you know what? It's an equity fund. It's already paying out 1.5% of commissions. So my assessment is that 1% is the cutoff. If it is paying anything more than 1% of commissions, the new structure, because of the math, it adds up in such a way that the amount that is now removed from this TER limits is the GST element. The GST element for commissions that are currently more than 1% have an element of GST that is more than 15 basis points. Now, why 15? 15 basis points is the number by which the BER limits have come down. So that means the limits are down by 15 basis points. So if I was paying a GST of more than 15 basis points, in the new regime, I have a benefit. Quick note, let's say there's a fund that charges currently 1.8%. And I'll give you 2 examples. First example is where the fund is paying 1% to the distributor, 0.8% to me, the fund manager, the AMC of the fund. I still make my 0.8% because the GST on it was anyway outside of this ambit. 1.8% was the limit. 1% I was paying the distributor, but that included GST. So he was getting 0.85 plus 0.15. Now they have reduced the total limit from 1.8 to 1.65. When they reduce it to 1.65, I get 0.8. My distributor gets 0.85. That adds up to 1.65. No change at all. Now let us assume that this was a different fund and I was a struggling fund manager and I said, I'm willing to pay you 1.5%. I'll keep only 0.3. Now this 1.5, the same math works out to 1.27 plus GST. So remove the GST out, 1.27 plus my fee, which is 0.3, 1.5% to the distributor, 0.3 to me. 1.27 plus 0.3 is 1.57. The new limit is 1.65. So this sounds like a very small difference, 8 basis points of difference. But now this gives me a chance to say, well, I can do something with this. I can either increase my earning, in which case the customer does not benefit, or I can tell my distributor, I'll give you a little bit more. I'll give you 8 basis points more. I was giving you 1.27, I'll give you 1.35. So the distributor is happy, maybe he'll bring me more business. The third one is I say, listen, I know I can charge 1.65, but I'll only charge 1.57 because that's the break even now. Then the investor benefits. So in one of these 3 cases, the investor benefits, one case the distributor benefits, one case the EMC benefits. So clearly, I think here that the customer benefiting and the investor benefiting is unlikely. Because while I made some extreme examples, the differential will be only about 2 or 3 basis points in general. Now 2 or 3 basis points is huge for me as an AMC. Because I can get 2 or 3 basis points, I can increase my earning by 10 or 15%. I give it to the distributor, he's a little bit happier. But the customer doesn't necessarily care. If I tell you that your TER has come down by 0.04%, you're looking at me and saying, just earn that by putting...
No, that's not what's going to make me stay with you. I'm going to look at your returns and if the returns are good enough. But look, so in equity, this is very clear. In debt, maybe it makes a difference.
Yeah, debt, well, mostly debt people don't charge at the limit because it's very competitive as a field. And debt returns are capped.
And I guess there's not that many distributors in debt either.
Yeah, most of the money is direct. Okay. So it's not so bad. So there, I don't think these issues matter at all. Having said that, it's simple. If you're a distributor, what makes a difference for you is, am I getting more than 1% from this fund? 1% is the cutoff.
Okay.
If I'm getting more than 1% from distributing this particular fund schemes, then I will probably have some headroom to charge or demand some more. If I'm receiving less than 1.4%, 1%, I probably will have to have a conversation because the AMC will come back to me and say, excuse me, reduce this thing.
How much you're making.
how much you're making. So I want to negotiate that down, right? Because if I am not willing to budge from my fee, then the AMC has to reduce its fee. Now the AMC has another challenge. It used to be able to charge 0.05%, 5 basis points, replacement for the
Exit load.
exit load. There was an exit load that used to be charged. The exit load used to go to the AMC. SEBI changed the rules to say, no, the exit load should go back to the fund and benefit the remaining investors in the fund, which is great. So what we used to do, what had to happen was the AMC said, listen, we are losing all this money. They said, well, you can charge 0.05% now.
More in lieu of not having an exit.
Yeah. So now this 0.05% extra, they've said, listen, it's lasted its time. Now
We're taking it away. Yeah.
they have taken it all away, and now we don't have exit load 5 basis points anymore. So the AMC has to lose the exit load extra, and it has to now work with their distributors to see who makes the extra. If there's headroom to play with. If there's no headroom, then it has to figure out who loses the money, or maybe they share the balances. The investor might benefit from the 5 basis point reduction in the exit load wala thing in any case. But I think what they do benefit on is the second layer, which is the brokerage changes. So currently, the way the system works is that you can charge up to 12 basis points in brokerage. Now, typically, this 12 basis points is including GST and everything, right? So if you charge 10 basis points plus GST, it comes out to 12%. There's some statutory levies and charges and all that stuff. So the current rate was roughly 9.6 odd percent plus GST and plus other levies. Now they're saying this 9.6% should be brought down to 6%. So all the institutional brokers in the game, CLSA, for instance, an institutional broker and so on, will see a reduction in the brokerage from the 9.5 they used to charge to 6 basis points.
Assuming they were charging the max.
It is also true that the industry has negotiated on commissions, and 6 to 7 basis points is roughly what the industry already pays. So they have been, I think we are going to see a lower effective expense ratio because of the reduction in this 3 basis points of reduction in the transaction charges. To give you an example, if there's a 1,000 crore fund and the 1,000 crore fund buys things, the cost used to be 0.1%. Let's say it only buys things. It does not sell at all. Then 0.1% of that would be, say, 1 crore rupees. A broker servicing this gamut of this entire AUM is about 1,000 crores. For this entire 1,000 crores is making a total of 90 lakhs to 1 crore as brokerage for handling the transactions on this. If they did a buy and a sell, then it would be 2 crores. The new deal will be you can charge only 6 basis points. So you can charge only 60 lakhs. So what was 1 crore or 90 lakhs has become 60 lakhs. So there's a 33% reduction in revenue from all the institutional broking that's happening. Now, one way to put this would be the institutional brokers typically hire a lot of sell-side analysts who do management interviews, do brokerage reports and so on. So maybe that will come down because of this. If you're a person who is an actual analyst on the ground or looking to be working in this field as an analyst on the sell side, remember that your chances have just gotten bleaker.
Because there's less revenue to pay for. So by and large, Deepak, I think there is the industry is probably going to get a bit cheaper for customers by and large. There may be a bit of a tussle based on the fund size or the current commissions being paid between distributors and fund managers, but probably favorable for both AMCs and for end customers. I think that's where the role would be, and perhaps better disclosures because there's now a more transparent TER number out there. In that sense, I think overall a positive move forward for the industry, and you can see that perhaps in the stock prices as well.
I would say the earlier expectation was 2 basis points. So because the consultation paper had brought down the brokerage to 2 basis points, which they felt that it was. So since it was 6, I think that is the reason why the stock prices reacted upwards today, is that, since you have 6, you'll have more brokers willing to work with you. But otherwise, the brokers may not be willing to work with you in the first place, right? So you don't want this kind of to come back and haunt you in terms of no block deals. The broker doesn't want to service you. He says you're a waste of time. But to an extent, people like us, we are not affected at all. We use VWAP algorithm. We don't want the broker to execute meaningfully.
So anyway, our numbers were much lower.
Our numbers were anyway lower. We were anyways much below the 6 basis point limit that is specified by SEBI now. But There are some brokers that have been around for so long with certain mutual funds where the charges have been this 10 basis
And they
points forever.
presumably provide value either in the form of block deals or sell-side research that someone finds
That's
useful.
the second part, yeah. But this is definitely going to help investors because it will bring down costs to investors and add to investor returns.
So I think one thing as a customer now, I feel I'm better off, if I may put it. I now see a BER, which is what I'm paying people for their core activities, and a TER, which is what I have been indirectly paying this whole time. I think you were giving the example that in an arbitrage fund, maybe the TER you saw was 0.4%, but because they've had to, like, whatever, do one transaction every month or one set of transactions every month for 12 months, the TER now might be something closer to 1%. We'll see based on what brokerages is being charged. So I am more informed as a customer. There is a bit more of a pie that is going to get split between everyone. It won't matter too much to the customer, but there is maybe some rebate that comes to the customer, and the rest is negotiated or brokered between the AMC and the distributors and so on. Brokerages, perhaps worse off. I mean, maybe the more expensive brokerage is worse off. So I guess career prospects for supply side research aren't so great anymore, right?
Yeah, I mean, in that sense, what happens is brokers use the money and then they provide research for free for the most part, right? So they use that money to pay their supply side, the sell side analysts to go and talk to management, set up interviews, do reports, and so on. Now, that becomes a little more dicey because the revenue has been crimped. So if you're looking for a job as a sell side analyst, the chances are you're going to be in a spot of trouble because the budgets will not be out there anymore. The quality of research, I think, will suffer a little bit, but by and large, there's lots of boutique houses now that do what is called buy side research. Effectively, they say, we are not going to charge you brokerage, just pay us. And there are these boutique research houses which a lot of mutual fund houses use as well because the quality of their analysis is quite good. So where they were getting research for free, they may have to pay for that research. And I think it's fair because at some point research has to be paid for independent of the brokerage. If you bundle it inside the brokerage, it creates issues. This is unfortunately a worldwide norm that brokerage companies bundle their research costs inside of the brokerage elements itself. But this is one step in which you'll actually bring down the cost and say, well, you can't pay them some crazy number. You have to pay them a relatively small number.
So, Deepak, I guess I'm most interested. 1 year from now, will we be looking at value research with BER or TER in the table of summary?
The TRs are going to be crazy because you're going to see large numbers, even in index funds, because index funds at the end of every, say, balancing period are going to have a huge lot of transactions. That one day you will see something like a 1% expense ratio. And you'll be like, dude, this is an index fund. It should only be charging me 0.01%. But that 1% consists of STT, brokerage, a bunch of other things that have applied because they've had transactions on that particular day. And the TER has bloated up. But the BER is the same. So the BER is, I think, the more comparable element. It's the one that has the ability to change. The TER is a function of transactions, and while in some cases in index funds you can't afford to change the number of transactions, it is also true that more high churn funds will see higher TERs versus funds which are low. And the fund manager always has the problem of saying, listen, if I don't churn, I'll have a low TER. That's fine. But if I don't churn, I might actually lose opportunities because I need to sell X and buy Y, and my Y is going to give me a 5% extra return on my portfolio. Should I give up that 1% TER, which is only to the few people that actually care about TER, and sacrifice a 5% return because of it for the 99% of people who actually care about returns?
So I think this is how all fund managers always say, why don't you look at the NAV? Anyway, that is post all expenses, and don't pay too much attention to the other stuff.
Yes, I mean, once the NAV is post all expenses, after that, it doesn't matter whether the NAV or the TR or the BR are really.
Okay. Thanks, Deepak.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.